I think if you look at absolute number of companies, I would say 10 and below is probably too low in terms of diversification.
Yeah.
What you really want is if you have 10 billion enterprise value on a small $50 million fund, you don't have a 4x net fund. You have a 10 to 20x net fund. My motto has to be, I need to have 5 to 10 unicorns per fund cycle. That's incredibly hard to do.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Aram Verdiyan is a partner at Accolade Partners, a fund of funds that was founded back in 2000 to back the best venture capital, growth equity, and blockchain funds, including the likes of Equal Ventures, Wonder Ventures, Notation Capital, Mucker Capital, Amplify, among many, many amazing others. In fact, I believe in a Preqin study not too long ago, before the pandemic at least, they found that 57% of your funds invested were in the top quartile, 21% were in the second quartile, and that purely puts you indisputably in the company of the best fund of funds out there. And between Aram's, your first foray into Accolade, as well as your return to it, you've done your tour of duty as an operator, as a VC, and the latter of which in Andreessen Horowitz's fintech investment team. Feel free to correct me if I'm wrong there. Outside of Accolade, Aram is the president and chairman of Washington, D.C. chapter of the Armenian General Benevolent Union, the world's largest nonprofit upholding Armenian heritage. And my friends, that's just the tip of the iceberg. So without further ado, Aram, welcome to the show.
Thank you for having me on, David. That was an amazing intro.
Well, thank you. If I missed anything, feel free to fill in the blanks over there.
No, it was more than I would usually do, so that was perfect.
All right, I'll take it. So I'm curious. So start somewhere. I would love to start, and this is something that was brought up in the pre-chat effectively, back at your time in business school. And with one of your professors, Pejman, who's now at Pear VC. And I asked you what might be a good tease, it might be a good story to lead into. And one thing you mentioned was the distance traveled. And this might be a non sequitur for most, it might be oblique and vague in many ways. But could you talk me more about what the distance traveled means, at least in the admiration you have for Pejman's life, as well as how it relates to your own life when you came to the US?
Yeah, I think you mentioned this tweet I put out back in 2017. Great sleuthing, by the way, where Pejman talks about where he was before he was a venture capitalist to now being really successful in building a great firm in the venture space. And the concept of distance traveled relates to your starting point in your career to where you are, not the absolute level of success you have achieved, but the distance from where you started to where you are today. And I think for Pejman, that's incredibly immense, which I really admire and found impressive. If you had to draw a parallel to me, and again, that's very subjective, but I came to the US when I was 15. Some similarities to Pejman, some not. And, I almost didn't speak any English, didn't think I would stay, came on an exchange program, and then one thing led to another. 20 years later, I'm still here. So the distance traveled has been high. I hope it can get even larger and larger over time.
There's a lot that was skipped in that narrative. A couple leaps of faith out there. When you came here and you spoke very little English, and you found yourself in the world of America as an exchange student, how did you build comfort? At what point in your life did it go from I wasn't planning to stay here for too long to I want to be here for a long, long period, and you're still here in America? So like for the rest of my life, effectively, when you were 15.
It was a long time into it, David. I still think even today, and a close friend when I joined business school said, I have a severe case of imposter syndrome, and I think I do. And you always, every year that passed by, I still thought, this is probably not going to work out. I'm going to fail, and I'll tell you, even now, I think that quite a lot. There isn't a day where, I think back and say, okay, this is great. I've made it. There's always this self-doubt because of how you started to. So I think it wasn't until I was in college. So maybe fast forward 4 years, 5 years, and I went through a number of interesting things in college where I got an internship at a bond desk at a firm on Wall Street you would know well, and then 2 months later that firm went under and the HR person who hired me wasn't there anymore. So I got a job in real estate. I was a real estate agent for a couple of years. Then I came out of school and somehow found my way to Accolade, which was like 100% right place, right time. So I think as things fell into place and there was a lot of right place, right time, I started to gain more comfort that I can stay on this path.
Do you remember the self-talk you had as you were, and even probably now or even the prior years, but like of when you felt imposter syndrome? I imagine it probably happens in specific scenarios. What was your self-talk to get out of a potentially negative feedback loop?
When you start a career, you feel like you self-doubt whether you're going to do well. So you extra prepare. You go home and you study. And when I got to business school, I felt like maybe I don't belong here. This is an amazing business school. So massive imposter syndrome there. When I went to class for the first day, I felt that. When I got my internship at Andreessen Horowitz, I felt that. I think it results in you like over investing in whatever it is you're doing to make sure you can be successful. And I don't like with time, I don't think that's faded for me.
I love it. I also want to go back to a bookmark, at least a mental bookmark I had in my head. I think you used the phrase, I somehow found my way to Accolade. But if I did my homework right, I believe
I did. It was I cold called. Well, I applied online. They never got back to me. So, and I was local. At that point, I'd been at I was working at Deloitte Consulting for about a year and a half, and I cold called them, and my cold call was very simple. It was literally, I want to be on the investing side. I know I don't have a ton of experience, but I'm local. I would love to come in for 30 minutes. At the very least, I can just buy you coffee and have a chat to learn about the firm and the work you guys do. And then 4 or 5 rounds of interviews later, I got the job. But it was, without the phone call, they wouldn't have interviewed me, even though I applied for the job.
Do you think the big draw to them was the fact that you were local, or the fact that you just were very passionate about being on the investing side?
I think they just found it weird, and they were like, this kid is persistent. Let's just meet him, see what he has to say. I literally think it was that. And look, persistency pays off sometimes. So in our job too, like what we do, whether you are doing fundraising or you are making investments, like the follow through, the persistency is important.
So speaking of follow-ups, you went through 4 or 5 rounds of interviews. Did you find yourself following up with them after every interview? And if so, like, what do you remember what you had in those emails or those communication that best helped you get to the next round, if it wasn't just the interview itself?
I don't know. I don't remember if there was anything specific on the follow-up emails. I do remember when I got the case study, and it was a fund manager I had to evaluate and make a recommendation for. I had no idea what to do. Like I had never done fund investing, and this is the imposter syndrome kicking in, saying I'm going to fail this interview. So I poured days into just trying to understand the space, analyzing the manager. I do remember the amount of effort that I put into the case study going into the interview, but the rest was just usual, I would say. Nothing special.
Do you remember how or what frameworks you used to evaluate that fund manager in that case study? And the follow-up question here, which you don't have to answer now, is how does that differ from how you evaluate a fund manager today, which will be a good tie-in for later?
Wow, this was a long time ago. This was 12 years ago.
I'm asking you from, this is, I believe it's 2012, circa 2012.
By the way, you know the other thing that I did that was bold and stupid? So now we have a similar case study, and we interview analysts, and they come in with a whole deck of the manager and the analysis they did. I came in with nothing. Everything was just in my head. Literally nothing. And I just spoke to it for 20, 30 minutes. So if someone did that today, it's a harder sell.
Right.
So I don't even have anything to go back. I don't have anything to go back to document what I said. But I think some frameworks were, look, there's a lot of basic frameworks every LP uses. Track record, fund size, team. So I focused on those things. But how you interpret them and how you double click on that, I think was very different for me knowing nothing versus today how we do our diligence on managers.
as you were looking at the track record fund size, like same things most people start looking at, were there rookie mistakes that you realized you ended up making? Or are there, like, maybe not you, but in a broader sense, for first-time LPs, emerging LPs, rookie mistakes, what they make when they just look at track record, fund size, check size, all that kind of stuff?
This is generally speaking, not for
Generally speaking. I
back.
mean, if you want to tie it, like, concrete examples always help, but more so generally speaking.
I think so. Track record is incredibly important. I also think relevancy of track record is very important. So, track record as an angel investor to starting an institutional fund are two very different things. Now, the way you can really dig into that is actually talk to the portfolio companies that the manager invested in to get a sense of their level of involvement, whether they can be an institutional lead manager versus an angel investor. Then, I think there's a track record. You were at a firm X, now you're on your own. Like, that track record has its own nuances too. Like, you are operating within a team. Like, how is that going to be different in a big firm? And how is that going to be different from operating solo as a GP? So track records, I think, like, you can look at the numbers, but the numbers themselves don't tell you a story. You have to double click into the qualitative aspects of the track record, the relevancy, how, I think you mentioned, sourcing, winning, picking. How was that actually done to arrive at that track record?
And is it repeatable?
So all those, and is it repeatable?
Yeah.
And like the repeatability comes in the strategy, fund size, portfolio construction. Right? So like, if you had $1 million angel fund, now you're raising 200 million. I'm just spitballing. Like, can you connect the thread of those two dots? Is the strategy similar or different in any way? Is the way you're constructing the portfolio and writing checks different from the track record you had before? I think all those things are important as part of the track record.
I totally get that. Yeah.
But by the way, that being said, like, we do a lot of fund ones, where you can have a track record from somewhere else that ties really well to what you're doing in fund one, based on all those factors we just talked about. It doesn't mean you have to wait for fund three to say, okay, well, you have a fund one, fund two. We see repeatability, we see consistency. Now we can back the manager. We actually like being very early with managers, typically at their first institutional fund.
When you say track record for a fund one, obviously it's not the same track record as a fund three would have. What are things you typically look for in a track record? You mentioned relevancy, so I imagine if they're a spin out or an angel, like let's say they've made 30 investments, maybe it's only 10 investments that actually fell on thesis versus the 20 that were off thesis. Are there other things you would look for in a fund one to better help you understand qualitatively and quantitatively?
I think you have to look at just the depth of the track record in terms of length as well. It's not a track record over 6 months versus 2 to 3 years.
Yeah.
Because you want to be able to see some longitudinal data in the track record. And also when you reference the track record, be able to, whatever that reference is relevant to what the manager is doing going forward.
Yeah.
So there are many cases where a manager wrote a $200K check, but they could have written a $2 million check. And you can find that through diligence. And then maybe it makes sense for that manager to raise a bigger fund because they have the ability to write bigger checks. So I think those are the things we'll be looking at as well. So track record numbers, longitudinal data, references with entrepreneurs, and then you really dig into the sourcing, picking, winning of the track record. Are those three things relevant? And I'm using your framework and what you mentioned earlier. So
I'm gonna be honest, I borrowed this from a combination of both Samir Kaji at Allocate episode 8, as well as Ben Choi episode 6 of Superclusters.
I love how you remember the actual numbers for each episode.
Well, I'll be honest, like, I'm only in season 2. I don't have that many numbers to go on, right? Like, if you talk to me 10 seasons later, I might struggle a little bit. But now, if I'm forgetting it now,
you'll have your own fund of funds by then, David. You won't get to season 10.
We took a sidetrack there. But I want to double click. Speaking of double clicking on things, I want to double click on portfolio construction, which is a soft spot for myself, something I personally look for as an individual LP, but also I know something that a lot of our listeners are deeply, deeply fascinated about. And so let's take a moment to walk through the behind the scenes of Accolade's portfolio construction. And if my research serves me right, and I do want you to course correct me here, but In the yin and yang of portfolio construction, Accolade takes a concentrated portfolio angle as opposed to a diversified, where each of your fund of funds invests in about, I want to say 15, 20 managers, if not less, each underwritten so that, and I quote here, a single fund's performance returns half your portfolio.
You're correct on the concentrated portfolio.
Okay.
So the power law very much applies to venture.
Uh-huh.
Right? So the top 10 companies, top a year drive most of the returns. There's only a handful of funds that get into those companies early on. And so you look at top decile versus average, the delta is much larger in venture than any other asset class. And so as a fund of funds, what you want is a single manager to meaningfully impact your overall portfolio. Now, meaningful impact is a broad word.
Right.
In a typical fund of funds, if you're making 15 to 20 underlying fund commitments, say each manager has around 30 companies, and you're trying to minimize overlap amongst the managers, you're generally looking at 400 to 500 these distinct companies.
Okay.
10% of those companies generally drive most of the returns.
You
want to make sure that the company that drives the return, you were invested in with the manager where you size it appropriately relative to your overall fund of funds. And so when we double click on our funds, the top 10 portfolio companies, not the funds, but portfolio companies, return sometimes multiples of our fund of funds. So individual companies, top 10, can return more than 1x your fund of funds.
Okay.
That's because, well, you pick the right manager, they back the right company, but you also concentrate a dollar with that manager so that a single company, 5 to 10x fund outcome can meaningfully impact your overall fund of funds return. I think it's very hard to do like a diversified fund of funds strategy because it's also like then you're getting sort of the average in venture, and the average in venture is not that attractive. Like, why are you locking up your money for 10 plus years? Just do traditional private equity where liquidity is better, or public markets. You might be able to get similar, if not better, returns. You're doing venture for the top 10% access.
That makes sense. And I assume this is what you meant when we last chatted and you said there are some models that just don't work, portfolio construction models that just don't work in the venture capital world.
I don't know if I think that's too absolute.
Okay.
With everything I said, there will be exceptions. And I think that one was a comment for underlying managers and how they invest in companies. So we can talk about that. Look, I think there are other fund of fund models that work. It's just our model has worked well for us. You mentioned the Preqin data set. I'm not sure where it's dated from, where it's coming from.
I believe 2017, if I'm remembering correctly.
Oh, this is back from 2017.
I think so.
Yeah, so if you fast forward to today, like our model has worked really well. We have 6 in a row fund of funds that are top quartile.
That was the only public data I could find, but you have the private.
Yeah, and I don't know what, I mean, it's all these like pitch book Preqin, I have no idea. Like we don't actively post our data, so I'm not sure where it's coming from, but yeah, I mean, the concentrated approach has worked for us. It's also dangerous, right? Because if you pick the wrong managers, like that's going to meaningfully impact performance on the other end of the spectrum.
Yeah.
But like one thing you don't want to do, I think, at least for us, is our most recent fund is $500 million. Let's say you write $1 million check to a manager. Say you're right and they 10x the fund. Doesn't move the needle on your overall fund of funds. Then that manager is so successful, it's obvious they're great. Fund size gets much bigger, or if it doesn't get much bigger, you can't really increase your allocation much. You can't go from $1 million allocation to 30. Maybe you'll get to go from 1 to 5, still not meaningful. So what you want is as many dollars as you can early on with the manager.
And this might be not the best analogy, but like pro rata for investing in companies. If you put a lot of dollars in, hopefully, I wouldn't call it ownership target, but if you put enough in, let's say a $15 million commitment in, it is likely for fund 2 when they come back to you, they'll be like, hey, we'll take another 15, give or take, from you again, instead of the 1 to 30 jump, which is a bigger leap of faith because other folks are running at them.
Yeah, but the math is also interesting, right? For if you like speaking of pro rata, if the company is very successful, your cost average is going to keep going up and up and up versus the first round. So I do think we're big believers in put as much as you can in the first round when the entry valuation is lower, when you can get the highest level of ownership. Now, there's also the argument of you can run the math based on percentage of fund. A large percentage of fund will be in 2 to 3 winners. That can work too very well. But having shots on goal early on, sized appropriately with the first check, I think can work really well.
what does sized appropriately mean? Like, is there a range? Probably not a hard and fast rule, but like, is there a range in which you look at for sizing appropriately on entry point?
It's a combination of the manager's ability and willingness to lead rounds early on at the pre-seed seed. It's a function of their bottoms-up build of fund size and how they want to deploy the fund and how much in reserves they want to put to work. I think if you look at absolute number of companies, I would say 10 and below is probably too low in terms of diversification. Now, what you don't want is like a $50 million fund. And by the way, whatever I say, like there's models that have worked against what I'm saying. I just think it's harder to do that. But I'll walk you through my rationale. So take a $50 million fund that gets 5% ownership in a company. If that company is really successful and even with adequate reserves, typically those companies are going to end up raising a lot of money. So I would budget 50% dilution on that 5% by exit. So you own 2.5% of a very successful company. A $2 billion exit gets you 1x gross your fund. That means I need about $10 billion in enterprise value generated at exit to get around the 4x net fund, 5x gross around the 4x net fund.
Yeah.
Really hard to do that because in power law, only a really small fraction of all the companies achieve that.
Yeah.
What you really want is if you have 10 billion in enterprise value on a small $50 million fund, you don't have a 4x net fund. You have a 10 to 20x net fund. Because it's very hard to get those outcomes. What you want is at sub billion, you can still get a 3 to 5x. If you have home runs, now you're looking at an exceptional outlier fund. Now, on the contrary to what I said, there are some firms that have done well without getting high ownership early on. But you have to be very, very good at deal flow and selection to have multiple billion-dollar outcomes in every single fund cycle. If I have 5 to 10 unicorns in every one of my $100 million seed fund and I don't own enough of them, I'll still do fine. But my model has to be, I need to have 5 to 10 unicorns per fund cycle. That's incredibly hard to do. What you want is I should be able to return my fund on a 500 to 750 outcome. And if I'm getting a $2 billion outcome, I make multiple turns on my fund. If I have a $10 billion outcome, I'm in a Midas list, 10x plus outcome.
No, this makes so much sense. And if you got to keep going, please, by all means, do keep going. The flip side of this is I want to take like the quality of deal flow or the frequency of deal flow under a microscope for a second. How do you evaluate if an emerging manager, fund 1 through fund 3, has good enough deal flow that where like, let's say sourcing, right? Where it has good enough sourcing capabilities where they're able to underwrite those kinds of returns for their fund?
So for fund 1, you're going off of some level of track record. So we're going to diligence it pretty extensively. Talk to the founders, talk to our extensive network of other GPs, other people in the industry, get a sense of the reputation of the manager, how differentiated they are, what's their ability to see deals and win deals relative to other managers in the market. That's all qualitative on fund 1. When you're on fund 2, fund 3, a lot of the data you're using is on the prior fund. So let's say you're evaluating fund 2.
Right.
If you did fund 1, you're likely to do fund 2 unless something catastrophic happened. Team blew up, or fund size is 10xing from fund 1 to fund 2, or they're not doing what they said they were going to do in fund 1. In venture, you don't see a ton of traction when you're going from fund 1 to fund 2 in terms of the actual underlying operating traction.
It's like
of the
2-3 years later.
Yeah, but you can see up rounds, which are kind of a weak signal, but a signal nonetheless that other people are doing the next round. You can look at the quality of the syndicate of those companies. You are starting to see some operating metrics like early customer data, so that helps as well. So you can start to see some of the portfolio inflecting. If the manager is doing what they said they're going to do, if the fund size is staying disciplined, portfolio construction is what you thought, team is intact, like you are very, very likely to invest in fund 2. We don't invest in fund 1 thinking we're not going to do fund 2. We invest in fund 1 thinking we're going to do many, many funds.
When you say many funds, like what do you mean by many? Like 3 funds, 5 funds? Like how are you thinking about many?
Even more than that. Even more than that. So, and then by fund 3, you do have more data on fund 1. Now, I'm assuming a venture fund raises every 2 years. 2.2 years or so is the average in the industry. In COVID times, it was like 12 months. So that's changed. We're back to normal now. So you're at year 5 or so of the firm's history. So fund 1 should have meaningful data, not DPI data probably, but meaningful data where you can start making some projections when you talk to the actual companies, when you get a sense of their trajectory, how fund one can look. And then you do the same analysis you did on fund two, where you look at portfolio construction team, did they do what they said they were going to do? Then you look at fund three. By fund four, you're looking to see some DPI in fund one.
Yeah.
And you're looking to see realizations, are things working? And then similarly, you're starting to see traction on fund two.
Double clicking on meaningful data for a second. On between fund one and fund two, like they're coming to you back for fund two. You're likely going to do a fund two anyways. What are telltale signs or like telltale like meaningful pieces of data that are interesting to look at from a customer standpoint, from a fund standpoint? What are things that you typically look at that seems to disproportionately help you reach conviction on a fund two?
I think it's all the things I mentioned. Like
Okay.
we do re-underwriting every time we look at an existing manager, as we would on a new manager. We reassess the team, the competitive positioning. We look at how the portfolio has been constructed, just in terms of deployment, ownership, reserve strategy, etc., and how that now applies to fund two. Usually, so the next fund is bigger than the previous one, so we have to sort of do new modeling on a bigger fund size and how that works. And we do look at each individual portfolio company. So to get a sense of what is the company, level of traction, any follow-on financing, operating metrics. So we take all that data as part of our evaluation.
How long does a diligence process take when you're underwriting like a first-time person you're in, like a fund one per se? And does that diligence time frame, give or take, change on a fund two, fund three, like on subsequent funds?
If it's an existing manager, we're constantly in that mode.
Okay.
Like we are always up to date on the portfolio. We track every portfolio company under every fund, under every firm. So we're not one of those LPs where our existing manager is coming to market. Okay, we're taking the next month and we're going to do work on this manager. No, like we've continuously done work leading up to that moment. At any point in time, we need to have a clear opinion on the manager.
Yeah.
Because we have the data leading up to it. We shouldn't be waiting for a moment in time where the data room is launched and then we do our work. Now, with new managers, it's a little different. We still like to get to know managers over a period of time. Even if it's a new manager, it can be a long process where we get to know them either during one fund cycle, or if it's a fund one, we get to know them even before they raise a fund. On the growth equity side, we've done some managers which were fundless sponsors. They did SPVs before they started their first fund. We love that model because we get to see how the team works. They do some deals, they have a track record, and then they raise fund one.
On the context of continuously collecting data from like onwards, like what are sources of that data you would look at? Obviously, LP updates that probably come in every quarter or so is where you collect it. Are there anything additional that you're doing in order to collect underlying company data, fund data, and all that kind of stuff?
The primary source you get data from, obviously, all the things you said, AGM, going to the annual meetings, presentations, quarterly reports, etc. It's actually talking to the managers and the companies.
Yeah,
that's the best primary research data you can collect, and we do that consistently with our managers. So, at any point in time, we should be able to look at a manager in our CRM and look at their companies and know which 2 to 3 companies are inflecting, which ones are too early, and triage that.
But is there a minimum viable team size that's necessary to continue to do diligence on, let's say, a portfolio of 10 to 20 managers?
So what's team size for,
like
Accolade?
For Accolade, like for a fund of funds, right? If a fund of funds or some LP were to do diligence continuously like you guys do, in terms of monitoring all that data, is there a minimum viable team size that's necessary for it? Or can it be like a 1-2 person show?
At the fund of funds.
At the fund of funds.
Oh, I know you're asking these questions about when you start your own fund of funds. Can you do this yourself?
Hey, I'm asking the rookie questions here. I'm scratching my own itch. Let me do that, Aram.
Yeah. It really depends on what kind of a strategy you're running. Like if you're running a concentrated portfolio and you're focused on one specific niche, like maybe a small team can do that. Like in blockchain, to give you a sense, we've now diligence close to 500 individual venture blockchain managers. It doesn't include any hedge funds, trading funds, etc. And there was a point in time, like my partner and I could do it while covering venture and growth. Now we have a dedicated partner who is focused on blockchain who works with us, and the 3 of us cover it.
Gotcha.
So it really depends on the maturity of your program the type of managers you're looking at. I mean, I know solo GP fund of funds that cover just seed or cover just small niche areas within the private equity space. So
I think in the world of venture, there's like a soft rule, or I heard this somewhere, so feel free to correct me. You have more miles on that odometer compared to me, but I've heard that per partner, you probably want to have like 25 to 40 million dollars to deploy per partner on the venture side of things. So in the sense that they can spend enough time on board, spend enough time diligencing deals, looking at deals, investing in deals, supporting, and all that kind of stuff. Is there a similar corollary in the world of the fund of funds where per GP of a fund or per partner of a fund of funds, they're looking at X dollars of capital?
I don't know if I agree with the 25 to 40 per GP analogy. Like, it depends on the strategy. If I'm running a Series A firm, my one check could be 20 million. And it depends on, am I a newer GP and I am not sitting already on 14 boards, or can I only do 1 to 2 deals in the next fund cycle? I think it's all relative to that. Now, if I'm running a pre-seed strategy with 50 million, sure, 25 million per GP could make sense. I think it's all relative.
It's a function of what sounds like stage,
strategy, and capacity. Like, how much capacity for new deals does that GP have?
Okay.
Like bandwidth, right? Like, if you're thinking about, like, I'm on 10 boards, but I'm going to roll off over the next, like, 5 boards in the next 2 years so I can do X number of new deals. That's your math. Like, it should never be an absolute number. Everything we do and everything we analyze for a GP, it's a bottoms-up approach. Like, if you're arriving at 25 to 40 per GP, I don't care about that number as much as I care about the build on how you got to that number.
Gotcha.
For us, we've never thought of it that way.
Okay.
My simple test, David, is if an LP ever asks us about a manager in the space we operate in, blockchain, growth equity, venture, and we don't have a solid opinion about that manager, then we're not doing our job. Then we are too bandwidth constrained. We should do less. That's my test. Are we seeing the new managers? Are we in the flow as anyone else, any other LP is in the market? Those are sort of the two tests. One is your subject matter expertise. Second is like your ability to source win deals. If those two are humming well, then you can continue at the capacity you have. If those two are not humming well, then you need to slow down and do less, like you said. So,
what does humming well mean to you? At what point do you look back at your own kind of schedule bandwidth and you're like, hey, actually, I've spent like too much time or like on other things and too distracted? Is there a proxy corollary test you do among your litmus test you do among yourself to figure out like, hey, I'm too bandwidth constrained. I don't have an opinion on a manager anymore.
So that it hasn't come to that. Like,
okay,
like I will always take a first time call with a manager. Always. Like, I'm never gonna pass it to someone else, or like and our firm culture is that. Like, we will always take the first. Like, we don't have IR. We do our own fundraising. We don't like have this model of like someone else takes the first 2 calls, then we later get looped in. Like, we have zero hierarchy, and everyone gets to do everything, whether you're a partner all the way to analyst, in terms of like the first call with the manager. So from that standpoint, I've always felt like we have the bandwidth still. Now, if we expanded into other geographies, if we did other strategies, I think it would be hard, because like that one thing we've done well is even blockchain, which we expanded into, it was part of venture. It was a natural extension of what we did. We never expanded the firm in a way where we said, okay, well, we need to hire these 3 people because it's a whole new different strategy, or we need to open a Europe office and have 5 people there. Right? We've never done that.
Right.
Everything we've done over the 24 years at Accolade is a natural extension of what we thought we were good at.
That makes a lot of sense. As Warren Buffett, and I'm loosely quoting him here because I don't remember his exact terminology, but only invest in what you know.
I think the test to do anything new at an allocator, any asset manager, venture, fund of funds, whatever it may be, is like, are you good at that thing, and do you have the sufficient bandwidth to actually execute on it? And so for us, by doing it as a natural extension, like blockchain, we were looking at all these blockchain managers already and diligencing them as part of our venture strategy. But it got to the point where we needed a dedicated product. Now, did we need at that point to hire someone and say, we don't know how to do blockchain? No. It was an extension, we could do it ourselves, so it made sense to have the product. But I think there's a lot of other products that would never make sense for us because you need to hire a new team, and it's not a natural extension of what we do.
One more question before we let the floodgates open on the blockchain topic.
Keep it for last, because then I don't know if we'll have enough time for anything else.
We'll keep it for last. We'll keep it for last before we get into some softball questions. I want to talk about consistent check size. And something I've come across while I'm doing homework for this conversation is that I found, or once again, correct me if I'm wrong here, that you would write as large of a check into a $20 million fund as you would into a $100 million fund. So like hypothetically, if you wrote a $15 million check into a $100 million fund, you would write the same like $15 million check into a $20 million fund to take like possibly like 75% ownership. And I'm curious, could you walk me through how that practice came to be?
It's the comment you made on concentration.
Yeah.
We don't have like varying levels of conviction.
Right.
Oh, I have enough conviction to write $1 million check in this manager, but I have enough conviction to write a $20 million commitment in this manager. If your commitment level is that big of a range, then you shouldn't do the $1 million commitment. You should only do the 20s.
Right.
And again, it goes back to like, if I do a smaller check in the manager, doesn't move the needle on my overall fund.
Mm-hmm.
What you want is each manager we back them with conviction, and we want them to move the needle if they're successful on our overall portfolio returns.
Right.
We are fortunate enough, we're not an LP where we have concentration limits. We can't be more than 10, 20% of a fund.
Right.
Like we're fine being 75% of the fund if it makes sense in that situation. We've done that. So yes, if it's a $200 million fund or a $50 million fund, we would write a $25 million check in each of those.
I know I sprung up this question, but if you could explain to our audience who may not be familiar with concentration limits, like of 10, 20%, can you explain why some LPs may have concentration limits at 10, 20%?
I think it depends on the entity, like the pension funds, et cetera, might have those limitations, and there's nothing they can do about that. It is instituted by their policy, so they need to have, and it varies, right? I use 20% because I've seen that quite a lot in the LP world of 20%. I also see it at the 10% mark as well, and that can be a challenge for managers. Because say I'm raising a $50 million fund, and then I come across this amazing pension fund that loves what I do and wants to invest in me. Their minimum check size is 30, but they can't be more than 10% of a fund.
Yeah.
Or 20, and they can't be more than 10% of the fund. Immediately, and they're like, we're willing to write a $20 million check, but we can't be more than 10%. I'm looking at that saying, okay, well, that means I can raise a $200 million fund and you'll give me $20 million. But my strategy works at 75, maybe 100.
And I've seen a lot of fund managers like, oh, you know what? This LP was willing to write me a $5 million check, but they have a 10% limit. I was originally going to raise like a $15, $20 million fund, and they changed their fund size as a function of how big of a check the LP can write.
And I go back to your fund size should be a bottoms-up exercise that will make sense from a portfolio construction deployment standpoint.
Yeah. What do you think about the toggle method, actually? I've seen a lot of folks like, hey, we can toggle between a $20 to $50 million fund where our, expected target is 20 and then where our cap is 50. Like, what do you think about those?
What's the input of the toggle?
Usually it's like reserves. It's usually like number of checks. That's what I usually have seen.
It depends. It really depends.
Okay.
Like, are we going from 15 to 30 companies? That's probably too many and too much of a deviation from the original plan. Like, can you handle 30 companies?
Yeah.
If now the fund is going to be, instead of 60 initial 40 reserves, it's going to be 20 initial 80 reserves, that's a problem too, because you're cost averaging into A's and B's far more than you are into the initial check.
Right. It's a different strategy.
So it really depends. It really depends. I think the toggle is fine if the band is small enough, and again, you can connect the dots between the two. If you're saying, I'm going to do 15, 16 companies, I'm going to end up at 20.
Mm-hmm.
Like, that's more reasonable, right? Than like doubling the company size, company count.
That makes sense. Because like if you've gone from 10 or like 15 to 30 or 10 to 30, it's like you've gone from concentrated to what the beginnings of a diversified portfolio as well.
Now, by the way, like, there are some really interesting models in venture, which have like 50 companies. Mm-hmm. But somehow, because of the program or the way they're running it, they can get high ownership for those companies at a very small check size. Maybe it's like an accelerator incubator program. Right. That's really interesting as well. So shots on goal, you can have higher shots on goal, but typically higher shots on goal means small checks, low ownership.
Right.
Sometimes you can have a lot of shots on goal, but because you're in a unique position at an accelerator, incubator, some sort of a program,
like a venture studio,
where you can still get high, or a venture studio where you could get high ownership. Then having many shots on goal is not a bad thing. It gives you optionality. If I can get 50 companies at 10% ownership, at a small fund, great, do that all day.
Oh yeah. And like, across the board for accelerators, they can get in for like very cheap. I mean, they set like the price point as well. Mostly on safes and all that, but they come in at such a cheap valuation, or quote unquote valuation for those who are listening, in quotes. That sorry, you can't see air quotes in when you're listening on Spotify or Apple Podcasts. Okay. We've held this at bay for long enough, which is the world of blockchain.
By the way, are you an angel investor? Are you LPing into any blockchain funds or have done any blockchain deals?
I've done no blockchain deals so far.
Okay.
So this is the tutorial for me, effectively.
Got it. Let's do it.
And so I'm seriously scratching my own itch here. So one thing I found really fascinating, which I believe like at Accolade you have this internal motto, which is like do not follow the herd. And I guess I've seen it on a couple like press release updates, and hopefully they're accurate. But one thing is that you once said that only after looking at 80 plus blockchain funds, did you and your team have the conviction to start a separate fund of funds vehicle to invest in blockchain. And as someone who came to America at 15 years old, like we mentioned earlier, knowing only a few sentences of English, thrown into the deep end.
You're drawing this parallel.
I'm drawing the parallel. And when your school did not have an ESL program, which is English as a second language, and you're reading Hamlet as your first book, which, let's be honest, is a very thick, hefty, $10 word filled book. And nevertheless, you found yourself picking up English so quickly. Are there parallels of you learning about the blockchain ecosystem as you did English? And how does one go from 0 to 100 in the blockchain space as quickly as they can?
No, I think that it's when I moved to the US at 15, knowing no English, nothing is going to be harder than that. Like that was just an absolute disaster. Like I didn't know anything. I have some funny stories for you later. But when we started blockchain, as I mentioned, it was an extension on the venture side. I still think it's a separate branch, but it has a lot of similarities on the venture side. The way we diligence managers, the sourcing, picking, and winning, that same mantra very much applies on the blockchain side.
Mm-hmm.
Like we diligence managers in similar ways, some very crypto native ways, but I would say it's probably like 60-40 or 75-25, depending on the manager, where 75% of the frameworks on traditional venture apply. By the way, that's a good thing because the institutional asset class for blockchain really started since 2018. And so you want frameworks that have been around for many decades to be applied to a very nascent asset class.
Mm-hmm.
And so we came in very early on in 2018, 2019, started making blockchain fund investments. And in 19, we got to a point where it wasn't just the 80 managers, it was spin-outs and high-quality managers where we thought we can't just do one or two of these. It makes sense to have a portfolio.
Mm-hmm.
We saw significant talent go into the space. And then we started to see the building blocks of blockchain really emerge, whether that's operating systems like Ethereum or decentralized finance started coming online. And then we saw market cap creation at the application and the infrastructure side. And we said, okay, there is a market here. There are a lot of high quality managers. We can't just do one or two of them. It makes sense to have a portfolio because we're so early.
Mm-hmm.
A diversified, but still concentrated approach makes sense.
Yeah.
But instead of doing one manager, we should do 15 managers in a portfolio. And some of the brightest minds are going to the space. So we should make a long-term 10 to 15-year bet of raising dedicated venture blockchain fund of funds. And so we did that. And so we've raised 3 funds now. I think we're the largest allocator globally. I'll pause there, but that's sort of how we got started. No, comparing it to when I moved to the US is hard because that was just that period was something else. Like I truly was learning a new language.
Right.
With blockchain, you learn a lot of crypto native concepts, but the frameworks of venture capital have very much applied here.
It's the what is the saying? Like history doesn't repeat, but it does rhyme.
Rhyme, exactly. Like sourcing in blockchain, it's very different, right? You source from many different channels than you would in traditional ventures. But like it's still like you can diligence a manager in terms of their reputation, ability to win deal flow, similarly to how you would a venture manager. Portfolio construction is wildly different, but we can use the same model from the venture side to apply to the crypto side.
This is more of a comment than a question, to be completely honest. I was chatting with we'll go nameless for now until I get their permission. Might include them after. But another of season 2's guests once told me about. He also actively invests into blockchain funds, and happy to introduce you after. By the way, as well.
Are we in season 2 or 1?
We're in season 2. We're in season 2 now.
Oh, we're in season 2 now. Okay.
Yeah. And one of the things that he told me in terms of talent of the blockchain space is that when there's a new industry with new technologies, a lot of engineers flood towards that. And even when the price of, let's say, Bitcoin or Ethereum falls, the talent that has learned the blockchain native technology stay in that because they've specialized and they're not going to switch out of after learning the specialization. Yeah. And so with each spike in the blockchain crypto world, you have a flood of new talent that raises the plateau for the next kind of tranche.
Pricing as an indicator, we try not to look at. We actually like looking at bear markets and seeing what the core developer growth looks like. And so Electric Capital, which publishes this tremendous developer report every year, you look at the 2018 bear market, developers grew significantly through that bear market. In the 2022-2023 bear market, overall developer count is down. But if you double click on that number, developers who've been in the space less than 1 year have mostly left. Developers who've been in the space for more than 1 to 2 years have actually grown over the past 2 years. And then you look at specific ecosystems that are thriving like Ethereum, that ecosystem has grown. The library usage has grown. The actually launching SDKs on Ethereum has grown.
It reminds me of, I think in the world of Formula One, which some of our listeners may be interested in, I think there's a saying, it's like, it's really hard to go from 13th place to first place on a sunny day, but it's much easier to do so on a rainy day.
Exactly. And so I think this market that we're in blockchain is really interesting. Core developers are growing. Infrastructure is being built. Valuations have reset, as they have on the venture side.
Yeah.
And fundraising is down, which is not a bad thing. Like, we are in a really small nascent asset class. At the peak, about 16 billion was raised per quarter in blockchain.
Holy cow.
But do you know what the number in Q4 of last year was? 700 million. Fraction of that. So we're in a healthy reset where high quality companies still get funded at lower valuations. And we're still early in the cycle.
How do you think about the time horizons of blockchain funds? Because as I understand it, this is speaking from a rookie in the blockchain space. Usually venture funds are 10, 15 years long, kind of like fund lifetimes. Is it the same for blockchain funds, or are you underwriting a different time horizon?
It depends on the type of investments the manager makes. So if it's a traditional equity investment, so take a company like Coinbase, which is just an equity investment, then you're looking at probably 10 plus years for a traditional IPO or an M&A event, like you would in traditional venture. So a lot of infrastructure blockchain companies would fall into that. Think custody, think security, think exchanges, etc. If you have a decentralized network company, so where there is a token component in addition to the equity, tokens can be utility token to use the product. They can be a way to bootstrap the network and acquire customers, or they can be a rev share with the actual token holders. All those are ways for you to program value into the token. That tends to become more liquid more quickly because the token has to launch typically commensurate with the product launch. In order for the product to be used, the token is actually embedded into that usage.
Right.
And so you could see at the sort of series A or B of the company, a token launch that has value in it. Depending on the managers, you can be locked up, and the lockup is not 6 months like in traditional IPO. You'll be locked up for multiple years with a linear vesting schedule. But you could theoretically start seeing liquidity early on. So years 3, 4, 5, if not earlier, for a venture blockchain manager. So it's a mix, I would say. But definitely, depending on the macro environment, depending on the type of investments the manager makes, you could expect to see significantly more early liquidity than you would on traditional venture.
That gives me so much to think about, and hopefully our audience a lot to think about as well. As we're in the back half of this conversation, and I've learned so much, Aram, on this episode. And I hopefully, as you revisit this and you feel imposter syndrome in the future,
I can't listen to my own podcast. I've never done it. I can't do it. It's just I'm gonna have one of my colleagues listen to it probably, but I can't do it. I've never done it.
That's fair. I will be honest. I know I'm doing the podcast now, but I hate the sound of my own voice.
Yeah, it's the same. I can't do it.
That's why I have an editor.
Listening to myself is excruciatingly painful for me.
Okay. Well, hopefully we'll have the transcript for you so that you can look back at this and then you'll be like, hey, you know what? This is why I shouldn't feel imposter syndrome, because I've spent so much time thinking, building, investing in this space that you've built such great frameworks around. And I know our audience will say the same as well. But as we get into the back half, I kind of want to throw you a couple softball questions here. And just like a purpose of this podcast is also get to know the face behind LPs as well. So maybe to start with, in terms of questions, for someone, and we talked about your GSB time as well, but from someone who once told your classmates at the Stanford GSB, and I quote here, that you had a sense that somehow you had landed at the GSB due to luck rather than your accomplishments, to someone who has once achieved an ELO ranking of 1467, at least publicly on chess.com, but in our time before, I think you've gone even higher during your when you were 13, 14 years old. But even with the 1467 score of ELO rating, and for those lay people out there, that puts you in the top 5% of online chess players. And all to say is, how much of your life do you think is architected around luck, and how much do you think is architected around skill?
Oh, I did not expect this question. Okay, so I think of luck in two different dimensions, David. So there is luck of I won the lottery randomly. Great.
Yeah.
I didn't have anything to do with it. And then there is luck that you're in the right place, right time, and you were able to make something of it with your own skill, but you were lucky enough to be given that opportunity in that time.
Yeah.
And then there is I had no luck and I've done everything with sheer will and power. I'm definitely not number 3. And I'm definitely not number 1, because I've never had this random event that has occurred to me that made me very lucky. I think I probably look back and say the majority of where I am today is right place, right time. And I do think that's luck. And coupled with the ability to have that partly imposter syndrome, partly working hard and having the skill, but without the right place, right time, I wouldn't have been able to do that. So I think the majority is luck, but there's a dimension to luck here that I think is important to stress.
I stumbled across I think it was an Instagram reel, which probably goes to say I doom scroll way too much on social media, but I need to curtail my time there. But one thing I found was, I think it was Qilu, who is with a chief operating officer and president at Baidu, was a huge part of the Bing search engine as well, in building Skype at Microsoft. And I think he was the executive vice president there when he was at Microsoft. But he once said luck is like a bus, and which obviously sounds very I had to double click on that. What do you mean luck is like a bus? And he says the bus will always come, and you might miss your bus every so often, but as long as you're waiting at the bus stop, the next bus will eventually come. And the only way to get on the bus to pay the bus fare comes in the form of preparation. And if you've done your work and diligence and homework and prepared yourself in a way, having the prepared mind, so to speak, you will always be able to get on the bus, even if you miss the moment where you thought you should have gotten on the other bus.
And look, I totally agree with that. And I think I was fortunate enough to be put in the right place, right time, where I could get on the bus. And I came from a world where I had many peers just as capable as me who were not given that opportunity.
I love it. So as maybe the last question over here before we round out, one of the questions I love to ask kind of our LPs out there, which is the idea of the anti-resume. So there's the anti-portfolio, which I think Bessemer has since shared online and all that, but the anti-resume, which is literally the resume that doesn't have all your accomplishments, but all the things that you probably did wrong, professional mistakes, things that you're most punitive about yourself in, just to paint a little bit more of the humanity behind who Aram is. Is there a time where a moment, an experience, a chapter in your life where you found you were most punitive of yourself, that you might have made a professional mistake, but you look back, and as Charlie Chaplin says, a tragedy in close-up, but a comedy in long shot?
It's a good question. When I joined Accolade very early on, I was in my early 20s, and we didn't have the success that we have today. We didn't have the series of top quartile funds that I mentioned that we had. We're early in our journey. It was a 4-person firm at that point. We're very early. And fundraising was much harder then than it is today. And as an early 20s person, I actually contributed on the fundraising side too, early on, which today, we don't need that type of help because it's easier. But And I will tell you, as someone who just joined the industry at the age I was at, I got punched in the face a lot doing fundraising. Sometimes dismissed just based on my age. And I remember those days when I would go home and think that I said something wrong or I did something wrong. And I would spend those evenings just studying the space, studying our portfolio, making sure that I'm more prepared for the next fundraising meeting. So there was a period, I think, when I was an analyst, where and like it was hard to raise, but on top of that, I'm a young person who's new to the industry, and going up against investment committees much older than I am, 2 to 3x older than I am. So I think there was a lot of learning there, a lot of go back home, prepare mind, go back, and then repeat and repeat and repeat, weeks and months out. So I look at that as a really great period where I learned a ton, and the rejections, the getting punched in the face really helped me to be where I am today.
I completely empathize with that. I'm currently sitting in that age range to time box myself.
When you launch your own fund of funds, fund one fundraise might be brutally hard.
It's good to know. Thank you for preparing me. I will walk in hopefully with a prepared mind, but as Mike Tyson says, everyone has a plan until they get punched in the face. And
yep.
I am also prepared for a lot of that. And also in my work here at, right now I'm at Alchemist Accelerator, and in the fundraising efforts also get punched a lot, to be completely honest. Well, thank you so much. This has been so fun, so insightful, and so many different wavelengths. I thoroughly enjoy this conversation, and my dopamine is still like hitting me in so many different ways. And so I think today is going to be a good day for me. At least for me, I'm still on the morning half of the day. So as a final note, I know, Aram, you're in quite a few places. You're on Twitter, you're on LinkedIn, you have your email out there. Where is the best place for people to find you?
It's not social media. I use social media for information consumption.
Mm-hmm.
So there was an analogy when I worked at Andreessen Horowitz, and one of the GPs there like framed it for me really well. They said, you can, whether you're an LP or a GP, you can either be really good at outward facing branding in terms of blog posts and continuously publishing, doing podcasts, or you can be on the ground working with the people and the constituents that you work with every day deeply. I am 100% in the second camp. So if you need to reach me, I call, text, email is the best way to do it, and I'm available at all hours. Like social media for me is like for information consumption. I am not the outwardly like going to post a blog every week type LP.
I respect that. I deeply, deeply respect it, and I can't think of a better place to end on. So if people want to find you, call, text, email. Hopefully not at 2 a.m. your time, because you are still human and you still need sleep. But
there's a good chance my son will be up, so I might be up too.
As you're tending to your son, you're like, oh, I just got this like text from a manager or an LP out there. But do take care of yourself. And once again, Aram, thank you so much.
Thank you, David. It was really fun being on this, and yeah, would love to reconnect again soon. Oh, I did not expect this question. Okay, so
hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are two completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for two reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist, and I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up, and as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, John, you're free to stay here for as long as you want. And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault. And it is the epitome of Peter Drucker's infamous line, which is, you cannot manage what you don't measure. And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of, LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. Like, they're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and at the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next, or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.